Today's meeting of the Governing Council, which was also attended by the Commission Vice President, Mr. Dombrovskis. Based on our regular economic and monetary analysis, we decided to keep the key ECB interest rates unchanged. We continue to expect them to remain at present or lower levels for an extended period of time and well past the horizon of our net asset purchases. Regarding non-standard monetary policy measures, we confirm that the monthly asset purchases of 80 billion euros are intended to run until the end of March 2017 or beyond if necessary, and in any case until the Governing Council sees a sustained adjustment in the path of inflation consistent with its inflation aim. Today, we focus developments since our last monetary policy meeting in early June. Following the UK referendum on EU membership, our assessment is that euro area financial markets have weathered the spike in uncertainty and volatility with encouraging resilience. The announced readiness of central banks to provide liquidity if needed, and our accommodative monetary policy measures, as well as a robust regulatory and supervisory framework, have all helped to keep market stress contained. Financing conditions remain highly supportive, which contributes to a strengthening in credit creation. They continue to support our baseline scenario of an ongoing economic recovery and an increase in inflation rates. At the same time, given prevailing uncertainties, the Governing Council will continue to monitor economic and financial market developments very closely and to safeguard the pass-through of its accommodative monetary policy to the real economy. Over the coming months, when we have more information, including new staff projections, we will be in a better position to reassess the underlying macroeconomic conditions, the most likely paths of inflation and growth, and the distribution of risks around those paths. If warranted to achieve its objective, the Governing Council will act by using all the instruments available within its mandate. Let me now explain our assessment in greater detail, starting with the economic analysis. Euro area real GDP increased by 0.6% quarter-on-quarter in the first quarter of 2016, after 0.4% in the last quarter of 2015. Growth continues to be supported by domestic demand, while export growth has remained modest. Incoming data point to ongoing growth in the second quarter of 2016, though at a lower rate than in the first quarter. Looking ahead, we continue to expect the economic recovery to proceed at a moderate pace. Domestic demand remains supported by the pass-through of our monetary policy measures to the real economy. Favorable financing conditions and improvements in corporate profitability continue to promote a recovery in investment. Sustained employment gains, which are also benefiting from past structural reforms, and still relatively low oil prices, provide additional support for households' real disposable income and thus for private consumption. In addition, the fiscal stance in the euro area is expected to be mildly expansionary in 2016 and to turn broadly neutral in 2017 and 2018. At the same time, headwinds to the economic recovery in the euro area include the outcome of the UK referendum and other geopolitical uncertainties, subdued growth prospects in emerging markets, the necessary balance sheet adjustments in a number of sectors, and a sluggish pace of implementation of structural reforms. Against this background, the risks to the euro area growth outlook remain tilted to the downside. According to Eurostat, euro area annual HICP inflation in June 2016 was 0.1%, up from minus 0.1% in May, mainly reflecting higher energy and services price inflation. Looking ahead, on the basis of current futures prices for oil, inflation rates are likely to remain very low in the next few months before starting to pick up later in 2016, in large part owing to base effects in the annual rate of change of energy prices. Supported by our monetary policy measures and the expected economic recovery, inflation rates should increase further in 2017 and 2018. Turning to the monetary analysis, broad money, M3, continued to increase at robust pace in May 2016, with its annual rate of growth standing at 4.9% after 4.6% in April. As in previous months, annual growth in M3 was mainly supported by its most liquid components, with a narrow monetary aggregate M1 expanding at an annual rate of 9.1% in May after 9.7% in April. Loan dynamics followed a path of gradual recovery observed since the beginning of 2014. The annual rate of change of loans to non-financial corporations increased to 1.4% in May 2016, compared with 1.2% in April. Developments in loans to enterprises continue to reflect the lagged relationship with the business cycle, credit risk, and the ongoing adjustment of financial and non-financial sector balance sheets. The annual growth rate of loans to households remained broadly stable at 1.6% in May after 1.5% in April. The Euro Area Bank Lending Survey for the second quarter of 2016 indicates further improvements in loan supply conditions for loans to enterprises and households, and a continued increase in loan demand across all loan categories. Furthermore, banks continued to report that the targeted longer-term refinancing operations had contributed to a more favorable terms and conditions on loans. The monetary policy measures in place since June 2014 have significantly improved borrowing conditions for firms and households, as well as credit flows across the euro area. The comprehensive package of new monetary policy measures adopted in March this year underpins the ongoing upturn in loan growth, thereby supporting the recovery of the real economy. In the light of the prevailing uncertainties, it is essential that the bank lending channel continues to function well. To sum up, a cross-check of the outcome of the economic analysis with the signals coming from the monetary analysis confirmed the need to preserve an appropriate degree of monetary accommodation in order to secure a return of inflation rates towards levels that are below but close to 2% without undue delay. Monetary policy is focused on maintaining price stability over the medium term, and its accommodative stance supports economic activity. As emphasized repeatedly by the Governing Council, and as again strongly echoed in both European and international policy discussions, In order to reap the full benefits from our monetary policy measures, other policy areas must contribute much more decisively, both at the national and at European level. The implementation of structural reforms needs to be substantially stepped up to reduce structural unemployment and boost potential output growth in the euro area. Structural reforms are necessary in all euro area countries, although specific reform needs differ across individual economies. The focus should be on actions to raise productivity and improve the business environment, including the provision of an adequate public infrastructure, which are vital to increase investment and boost job creation. The enhancement of current investment initiatives, including the extension of the Juncker Plan, progress on the Capital Markets Union, and reforms that will improve the resolution of non-performing loans, will also contribute positively to this objective. In an environment of accommodative monetary policy, the swift and effective implementation of structural reforms in line with the 2016 country-specific recommendations recently approved by the European Council will not only lead to higher sustainable economic growth in the euro area, but will also make the euro area more resilient to global shocks. Fiscal policies should also support the economic recovery while remaining in compliance with the fiscal rules of the European Union. Full and consistent implementation of the Stability and Growth Pact over time and across countries is crucial to maintain confidence in the fiscal framework. At the same time, all countries should strive for a more growth-friendly composition of fiscal policies. We are now at your disposal for questions.
Ms. Jones?
Claire Jones, Financial Times. Brexit has revived concerns that you will run out of bonds to buy for the quantitative easing programme. Did the Governing Council consider today whether to relax the rule, or was there any discussion of whether to relax the rules for government bond purchases, including potentially moving from the capital key rule? And would the Governing Council consider buying either equities or bank debt under QE? Thank you.
Thank you. As I said before, we discussed the general economic conditions. We concluded that we didn't have yet information to take decisions, and we decided, as I said, that over the coming months, when we have more information, including new staff projections, we'll be in a better position to reassess the underlying macroeconomic conditions. And no attention was really given to discuss specific instruments at this point in time.
Mr. Merli?
The IMF, in its recent update of the World Economic Outlook, singled out Italian and Portuguese banks as one of the risks for the outlook. Is that a view that you share? Is one of the risks that you're taking into account in your considerations? And do you think that some degree of public support for banks in the Eurozone is acceptable or indeed desirable?
Well, what I just said in the introductory statement, monetary policy is certainly supportive of economic activity and is focused on maintaining price stability, but also other policy measures are needed in order to reap the full benefits of our monetary policy. And one of them is to address the non-performing loans, more generally non-performing exposures in the euro area. And so that is a very important reform, and we certainly consider it important. I wouldn't say we consider it a risk, as you said, but certainly it has to be addressed. Now, it's a complex problem. We may actually come back on it later on. And what's the other question?
If some degree of public support for banks is needed or is acceptable or
Well, we have in place the rules. We have in place rules on state aid. We have the BRRD. And as I said several times, these rules contain all the flexibility to cope with exceptional circumstances, the power and the responsibility in activating these rules and in complying with these rules lies with the Commission.
Ms. Trigg?
Thank you very much, Johanna Trigg with M&I. I believe you have the survey of professional forecasters available, and I was wondering whether that was conducted after Brexit and what those shows, whether that had an impact on the growth and inflation forecasts. And you've said repeatedly that you need more data and you need more time to assess the exact impact. But it seems to be generally that most observers expect it to be a question of when and how much you might act. So do you think that people who assume that running ahead a little bit, is there a fair chance that you've actually done enough?
Thank you. Well, on the first point, I frankly can't remember whether a survey was done before or after. What I know is that on inflation outlook, the Brexit didn't seem to have any major impact at this point in time. Since we speak about inflation expectations, it's worthwhile pointing out that we have a kind of increasing divergence between the SPF expectations and the market-based expectations. The SPF expectations basically remain the same. It's 0.3 this year, 1.2 next year, 1.5 in 2018, and 1.8 is the expectation, the medium long-term expectation of the SPF. So pretty anchored. On the other hand, we had the market-based inflation expectations, which in the days immediately after Brexit fell significantly. And one immediate explanation was that there are technical factors that cause such a decline, namely that the impact on nominal bond yields was bigger than the impact on the linkers. And that reinforced this effect.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.